Welcome back, folks, to Wook Capital Management's monthly book club series. I'm Managing Director Rod Alsman. This month, we look forward to tonight's discussion covering The Warren Buffett Way by Robert Hagstrom. We're going to set up the discussion just with a very brief, maybe 10-15-minute summary of the book, and then we can kind of go around and talk about aspects of the book that folks want to touch on, takeaways from the book, etc. And it doesn't need to be too formal. For the sake of everyone, just if you're not speaking, please stay muted to minimize any background noise. I am recording this and it will be available on the Wook YouTube after. So, Joe, if you want to start out then just with the disclaimer, and then I'll dive right into kind of summarizing it, and we can go from there, if that works.
Yeah, let's do it. So welcome everyone to the Wook Book Club's discussion on the Warren Buffett Way. Just getting started here with the disclaimer. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual.
All right, with that mouthful out of the way, thank you, Joe. So this is I guess we're in the 10th month of the year, so I think this is our 10th book club. We've covered a range of finance and investing related literature, and now we're going to talk about what is an older book. It was published first in the 90s. There was a second edition out in the 2000s, and then a third edition out in the 2010s. So it's been in print for quite some time. I do think, though, for the purposes of our discussion, there's a lot of valuable meat still that holds true today as it did 30 years or so ago when it was published for the first time. So, the Warren Buffett Way, I think there was one very straightforward. I read the second edition. I will concede. I found a free PDF online of the second edition, and that was the one I read. So it was in section 4, buying a business. There was one graphic that I feel really effectively summarized just about the entirety of the Warren Buffett Way. I'm pasting the graphic in the Stages chat. It's really simple. There are a handful of tenets of Warren Buffett's investment philosophy at its heart that relate to the business, to management, to the financial performance of that business, and to value. And it's really not a very complicated read. I mean, you go and read through the book. It lays out the history behind Mr. Buffett's upbringing, how he became involved with in investing. The book starts off with detail behind his history and his path to the present, which is, of course, not today's present, but the present of when the book was written, which was the early 90s. It lays out his education, and then it lays out Berkshire itself to a small extent, and most importantly are, I think, the chapters on that add some meat to those tenets that are listed out there within the Warren Buffett Way, which it's really simple. There's a few real simple key takeaways from the book. As I kind of summarize it aloud, that Buffett is always clung to, and he's clearly been the most successful investor of history. So it's fair to say that the process that he adheres to can work for us as well as mere humans. But he really, like, there's a few good lines in the book that are not just from Buffett, but from some of his mentors, like Ben Graham, that I'll kind of rehash that I think help to summarize things. One of the big ones is that investing is most intelligent when it is most businesslike. And that was a Graham line that Buffett said were the like nine best, or I forget exactly how he said it, the nine most important words describing investing, something like that. But investing is most intelligent when it is most businesslike. And when he's looking for investments, when he's trying to be an intelligent investor, it's really a simple thing. He's looking for companies he understands that possess good economics and are run by trustworthy managers. And he's looking for that in businesses that he buys outright. He's looking for that in stocks that he invests in, the proportional share of ownership. But it's very clear that Buffett sees investing in stocks very similar to buying a business, and it requires sustained discipline in his view, which is the way he's treated it throughout his career. Chiefly in kind of the investing guidelines of the Warren Buffett Way and those business tenets, one of the most important things is that the business is simple and understandable, point one. And for him, he views it as investing in a circle of competence. So for many years, it was well known that Berkshire didn't invest in technology companies, didn't invest in the big tech companies that now make up huge chunks of the market for a long time, although it did eventually take shares in Apple and as a major shareholder in Apple. But I guess not to go too down a rabbit hole, he's looking to buy things he understands. He understands the economics behind these businesses better than all of us can dream to. But he wants to stick with the circle of competence and invest in franchises where there's a product or service that's needed or desired, has no close substitute, and is not regulated. So we can go through some examples later. Kind of second is then the importance of management tenets beyond just understanding the business, analyzing the business, etc., is to really invest with managers that you admire and you respect, you have love for the way they conduct themselves. So there were several examples provided in the book, but I think the quote that I bolded and underlined was, "The CEO who misleads others in public may eventually mislead himself in private." Thinking about the second edition that I read, there was a lot of talk about all these various frauds perpetuated by management in the 90s, late 90s, 2000 era, and how a lot of kind of corporate folks had lost the trust of the investing public. So he says to beware of companies displaying weak accounting. Another red flag of his is unintelligible footnotes. So if you can't understand footnotes in a financial statement or financial report of a company, then I assume it's because you're inadequate. It's probably management trying to hide something they don't want you to know about. He's suspicious of companies that trumpet earnings projections and growth expectations. No one can know the future, and any CEO who claims to do so is not worthy of your trust. So, and one other point from kind of the management tenets was this, the force that he calls the institutional imperative, the lemming-like tendency of corporate management to imitate the behavior of other managers, no matter how silly or irrational that behavior may be. So he wants managers who are rational actors, who are honest, and who are not just going to go along with that which their peers are doing. The third point or section, the financial tenets. Again, I'm just kind of summarizing this, and we can then go around the table. but for the financial tenants piece, he focuses on the return on equity, not the earnings per share of the business, which is his example provided as well. Earnings per share could grow 10% every year, but if equity is also growing 10% every year, you're not really getting improving returns on equity necessarily. He calculates owner earnings, which, when you think about free cash flow, net free cash flow less out maintenance capex, but again, this is an older comment of his, but according to Buffett, approximately 95% of US businesses require capex roughly equal to their depreciation rates. So we do all know, of course, that you can defer capex, but if you're going to defer, a maintenance spend, that simply means that spend comes back in a later period. It doesn't go away forever, and your business will likely decline. So he views owner's earnings, which is the free cash flow less the maintenance capex, as really being a true reflection of value that you should calculate as an investor. You should look for companies with high profit margins. What a no-brainer. And that for every dollar retained, has the company created at least $1 of market value. So those are kind of the financial tenets that he values most. Then on the value tenets, it's really, really simple. You have to determine the value of the business and then buy when the price is right. Only buy when the price is right. And the business is selling at a significant discount to that value. So the simple thing is it sounds so simple when you kind of try to put it all together. It's to identify these businesses that have the right characteristics, that have the right management characteristics, as well as operating characteristics, that have good financial characteristics, which will allow you to come up with a value. And then it's a waiting game. You may be waiting a very long time. There might be something, whether it's on the management side, that needs to change. Perhaps there's a bad portion of the business that needs to change, get spun off, sold, whatever. I think it's just so important to recognize that he doesn't really, I don't think it's talked about much in this book, but in other kind of Buffett-related discussion, that wonderful thing as investors is that we don't have to swing at every pitch. We don't have to swing at any pitches. We ourselves can be the ones who make the decision when and how to commit capital for investment. And he has obviously decades of discipline that's allowed him to build out his approach. You can, again, from chapter 1 and 2, kind of see his evolution, a bit of his evolution. The book discusses, sees candy, right, as a good example of how he's learned from Charlie Munger, finally, that buying wonderful businesses at fair prices is better than buying fair businesses at wonderful prices, with the See's candy being that they paid a large multiple over book value. And they almost didn't pay it up for it. And that business has obviously grown meaningfully today without much capital required to enable that growth. I think the discussions around insurance and reinsurance are very interesting to appreciate what it's enabled Berkshire to do and Buffett to do with Berkshire. But I'll go back to, again, just really the essence of the book is giving us some backstory on Buffett, helping us understand a few major contributors that evolved and shaped his thinking over his different stages of his career, from Graham to Fisher to Munger, and then kind of wrapping it up into one really simple, straightforward investment philosophy, the Warren Buffett Way.
I like this one. I really did. I think it was the most digestible of all of our books so far. If I had to pick a book out of our list, and maybe even out of all finance books to recommend to my parents, they're not very financially literate people. They, farmers, very small town, save a lot of money, but they don't even probably have it in any sort of high yield account. I don't think they have any sort of investments besides the farm they live on. So this would be a book I would start them out with. I think it's very simple. It teaches them more of the principles and less of the terminology, which I think is good because I think someone just learning might get scared away with some of the advanced financial terminology that you see in like some of the other books. But this book is a bit more about just like what principles can guide you in the right direction. And then I think you would read this prior to reading a book that kind of dives more down into the technical. So that's what I thought of it. Complements the annual letters well. Like if you like this book, then definitely read Berkshire's annual letters as well. And yeah, I thought it was a great one.
Yeah, I agree. I think so far when people ask me what they should read when they first start out with investing, I recommend The Little Book That Beats the Market because it's short. It's pretty straightforward. But my answer is not going to change to The Warren Buffett Way because, as Joe mentioned, this teaches everyone how to understand businesses and how to buy businesses instead of just trying to score opportunities that's just going to give a short-term return that we don't fully understand. And we see those opportunities everywhere. We see everyone talking about these new hot tech, these new hot trades, and it's so easy for beginners to get sucked in to that mindset of the fear of missing out. And reading The Warren Buffett Way can help all of us to remain true to what we're here to do, which is to find good businesses that we understand, find good businesses that has a long-term trajectory, and implement these ways that are proven by time by the world's greatest investor that we can very easily implement in our investing approach.
Yeah, so yeah, those are all really good comments. Yeah, I like this book because it kind of goes away from the typical academia or like some of the things that people talk about these days online. So a lot of the times people are focused on the EPS or they're focused on the cash flow or they're focused on all these things that you're taught in a book, and people are constantly talking about those things, but really like one of the great well one of the greatest investor, if not the greatest, is saying like some of these things are actually quite useless. Like you shouldn't be focusing on those things, and if you were to focus on those things, there are adjustments that you need to make, and they may not be appropriate for certain types of companies, like manufacturing companies versus a oil drilling company or some other different types of companies. So it's he kind of talks about those things, and it gives you like tells you exactly what you need to do. Like, okay, if you're going to use cash flow, you have to adjust that, and how do you adjust that? And he talks about those things. So I like how it's not just such a textbooky thing, but at the same time you need a certain level of textbook knowledge, and then it teaches you to kind of go above and beyond and try to find do it the right way, the Warren Buffett way. So I thought it was a very good book in that sense. So I really enjoyed it.
Right, so it's a really good balance of the technical and the reasoning behind it. Because I've read before, Warren Buffett is not a fan of EBITDA. He always thinks that depreciation and amortization, these non-cash charges that get added back, therefore get ignored. By investors often. You know, I always thought I always understood like the high level reasoning as to why Warren Buffett doesn't like EBITDA, but didn't know the concept of owner earnings. and this alternative that we can use to estimate cash flow, which is the most important thing when we look at a business. But he really dives into why this is relevant to investing, rather than just throwing concepts and telling people this is the way it is.
Although I will, can I just add one thing on top of that? He does, and that's why I like it. But I also wish that, like, it would be nice if there was like a follow-up book that goes a little bit more into detail, because it does explain it in very high level, so you kind of understand it, but it doesn't really get to the roots, like really like a full comprehensive understanding. So it would be cool if there was a follow-up book that goes a little bit deeper. It's kind of like where I was like, wish it was a little bit more detailed, but it's like good enough to just get a high level understanding.
When you say a little bit more detailed, are you specifically talking about like the company selection process, or what kind of detail were you looking for?
That would be like, for example, like he's like talking about how he doesn't like debt, but obviously he's not opposed to debt, right? And then he kind of talks about like there are different ways that you can actually, in fact, make your return on equity look better. And sometimes if you increase your debt to equity ratio, you can do those things. Then, like, what is like a better way to go about it? Like, what kind of debt is good, or like give some real use cases or case studies of these are the type of cases where this would be considered healthy, but it may look like it's healthy, but this isn't good. Like, I would like to see a little bit more like real life examples, and like kind of put into like a real life scenario. Whereas like, yeah, this is great knowledge. Yeah, he's right. Like, those are some ratios that we can look at and compare and say this is not good. But then, like, I also want to know like real examples. I want to see other case studies. So I guess that's kind of like the details that I want to see or read about.
I definitely feel on that. Yeah, I was just gonna echo what JP was saying, that it would be very nice to look at case studies, um, which I think exist. I feel like I've seen like Harvard Business School case studies on Warren Buffett, and some of the companies that he bought, which like gives more detail, kind of beyond these conceptual understandings with real numbers behind them.
I mean, yes, he does have that chapter. What chapter was it where he talks about like Coca-Cola and all the other all those businesses he bought, and kind of goes through those tenants. And um in that sense, it is, that part was pretty helpful. Like, it was nice to see that, but um it was just kind of, it was like a paragraph, and it was just like, yeah, this is good because it's this, and 20% equity, whatever. So it wasn't very detailed, as much as it didn't have as much detail as I wanted to see. In high
For
level,
sure.
like I said, it was good. Yeah.
Yeah, this book doesn't provide like the level of detail that I feel like as investors, if we really want to replicate Warren's methods, it's not enough. But I'm seeing that there's also a book called like Inside the Investments of Warren Buffett, with 20 cases, published by Columbia Business School. Columbia Business School. So there are books like this that kind of serve as like the follow up, as you suggested, JP. So maybe we can together kind of look into this, as our follow up discussion, and try to really learn what went inside the investments of Warren Buffett.
Yeah, I will note there is a book that attaches onto this one called the Warren Buffett Way Workbook. It was like recommended to me on Amazon when I purchased this book. So there is like another piece to this, but it's not nearly as highly rated. It's a bit more of a, says it consists of over 500 questions to help investors read through the Warren Buffett Way and reinforce the concepts. So it's something you could check out if you wanted more of this, but it's not quite exactly what we're talking about.
Yeah, I hear what JP, you and Han are kind of getting at. There's very general themes with perhaps not as much. Here's exactly how to effectuate these themes. Like he generally doesn't like leverage, but that doesn't mean that we get any detail on what's too levered, what's not, levered enough per se. I think it's because it's trying to focus so much on the core essence of, Hagstrom's trying to get at these very core components of his investment approach are repeatable by everyone, but very few people opt to think and act this way. Which, especially when we think about the complete chaos of the last few years, when Buffett says that you should think long term, 5 to 10 years minimum, I would argue, many market participants haven't even been thinking 5 to 10 months ahead in a lot of their activity of the last few years, and it's been hard, I think, with how uncertain the world's been over the last few years, which gets back to, the basic tenet is the business simple and understandable. And when you think about long-term prospects, well, people are probably going to keep, to use the Gillette example from the book, most adult males are going to continue to use a razor blade or to shave, regardless of what happens in the world in the future. Most people are going to continue to enjoy their carbonated, fizzy, sugary beverages, like with the Coca-Cola example. I really enjoyed the Coca-Cola example, just kind of understanding how Buffett hadn't been invested in Coca-Cola until Gazetta, the new CEO, came in and kind of, maybe the business tenets had existed for the Coca-Cola company, around why the business itself was stellar and has continued to generate outsized returns. But the fact that it took management getting into alignment, becoming rational. There were a few good details in the book on what Gazetta did with management to get people's buy-in on, telling the truth and sharing what's going wrong at Coca-Cola to make sure they can improve results, which they did massively by the time the company exited the 80s. So I thought that was a good example of where maybe Buffett knew and understood Coca-Cola, right? The book mentions he had his first Coke when he was 5 years old and had understood the business for a long time, but it took until the management tenets aligned with his values for him to make that large investment in Coca-Cola, which the company, Berkshire, is still one of the largest investors, I believe, to this day.
Right, the Coca-Cola example, it's so important for us to invest in a company where we really like the product that is simple enough to understand. But oftentimes, because Buffett is so well known for that, kind of going all in a product that he really likes and understands, that people might think that that's it, that he kind of ends there. But as you said, considering all of these tenets and making sure that they align with the investment philosophy is so important. Like to your point about Coca-Cola's management and how that played a factor in Buffett's decision making. It's something that people don't know about. People just see Warren Buffett, loving Coca-Cola all the time, drinking Coke all the time. Obviously a big investor. So this is another reminder that we should always consider the holistic picture when we invest in a company, even though the company has a super solid product that's going to last for decades. Even if we're 100% sure about that, what is the management like? What's their capex like? What's their capital structure like? These are all questions that we should hone our skills to analyze and evaluate before jumping into the investment. This book gives us the reminder to always focus on that.
One thing that also you take away from the book is what he chooses not to invest in. He clearly learned from the early investments in what was Berkshire Hathaway, the textile company, that high capital intensity, low return commodity businesses are not something that aligns with the Warren Buffett way. And it's interesting when we think about some of the different books we've read, the Peter Lynch one. He talks about investing in cyclicals and how important timing is when you're investing in that sort of stuff. This book does kind of mention with commodities that the only time you're going to get excess returns are when that particular commodity is undersupplied relative to demand. So it just by virtue of his duration being multi-decade, at least his intention being to hold forever in some cases, these companies, that it almost inherently precludes him from purchasing commodity businesses, which there is Berkshire Hathaway Energy. The book talked a little bit about the example of, I think, what the precursor company to Berkshire Hathaway Energy came to get into their fold, but it definitely cuts out certain swathes of the market from his. For one, because if it's not inside his circle of competency, he's going to ignore it. And understanding how wide or narrow your circle of competency is, beyond just the commodity piece of the discussion, I think is a really big aspect of this. I know for me, I've probably stepped into stuff that I don't have a circle of competency, and I probably overstretched my limits on investing in some of that stuff in the last few years. I'm sure a lot of people have kind of feel that way, but yeah. One other big thing that I bolded and underlined was from Munger in managing your portfolio. So in that section 10, managing your portfolio section, there was two things. One, the fact that Buffett views risk very similarly to Howard Marks. It's not the idea that volatility is risk, like the modern portfolio theory might try to say, but it's similar that they both see risk as things not going to plan, or risk is that you things don't turn out the way you want them to. It's not volatility in price. It isn't how they think of risk. And the second part of that chapter that we didn't talk about yet, that was, I think, really important to noodle on, especially as this fourth quarter is underway. It's already started out ugly for equities. Bond yields keep going higher. Who knows, if things are going to implode into year end? Who knows? Who cares? But the takeaway from Munger that when you are thinking, it was, if the new thing you are considering purchasing is not better than what you already know is available, then it hasn't met your threshold. This screens out 99% of what you see. The notion kind of being, you shouldn't be adding companies to your portfolio just to buy more companies. And you should always be kind of comparing against the best existing investment in your portfolio, which I think a lot of us at times find ourselves guilty of thinking, we need to diversify more. We need to get more businesses into our portfolio. And one big takeaway from what Buffett and Munger said in this book, as well as what we heard from, I'm fooled by randomness. I'm trying to remember which book it was, but this notion that you can be well diversified with a really tight, handfuls of companies that are outstanding companies run by strong management that you truly understand The Focus Investors Golden Rules from Hagstrom says 10 to 20. I think it was 6 to 8. You got from others. Munger even said mathematically you could get it down to 3. I wouldn't recommend that, but it really highlights that if you know what you're doing and you know the businesses you're investing in, and you're sticking within your circle of competency, that you really should only have a handful of companies, and when you're looking for additional investment, they should clearly be better than what you already have. Otherwise, it hasn't met your threshold, as Munger would say.
Yeah, and they talk about that. They're talking about how you should probably have somewhere between 5 to 10 different types of stocks in your portfolio, unless you're just an average investor and you really don't have a full understanding of different types of industries. But if you do, then you want to narrow it down to 5 to 10, because there's a chance that you may purchase something that you don't know enough about. And if you do that for the sake of just diversification and you're investing in things you don't know, then that's not a very good thing. So there's no reason to diversify for the sake of diversifying, unless you obviously don't know too much and you're just an average investor. Then maybe you can increase it up to 20, but the range seems to be around 5 to 10 is what they were saying in the book. And I also like the sizing part that they were talking about, and they were saying how if you are very confident about a company, you should be willing to put up 10% of your total assets into the investment that you feel very comfortable about. And that also, by that equation, it equates to 10 different stocks, right? 10 for each stock that you're super confident about would be 10%. So there's 10 different stocks, which comes out to be 100% and 10 different stocks. So it also makes you think, like, if you are that's if you really feel comfortable, you really know a lot, then you would put 10%. But I realize that when I feel confident, or when people feel confident these days, they typically go super hard, right? They'll be like, okay, like, this is like what's gonna change my life, and I'm gonna put 40%. Then that may be a little bit of a sizing issue, because if Warren Buffett's talking about that, if you're super confident, you would put 10% and you put 40%, that's pretty bad. But at the same time, I wish he kind of talked about that sizing part, because if you look at Coca-Cola, he actually it accounted for over 30-40% of his total portfolio when he purchased Coke. So why was it that he purchased 30-40% there, but when he's talking about diversification, he's talking about each stock should it pretty much be at 10%? Or is he not saying that? Is he saying that you can do more? But if you can do more, like, how do we determine that? Like, I would like some of those information, because that's obviously kind of contradictory to what he did, which made up most of his wealth. So I want to kind of get his idea, or learn a little bit more about that diversification and sizing component.
Yeah, he had a quote that I think ties into that pretty well, saying, I never attempt to make money on stocks. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. And that's also one of the quotes that I tweeted out about this book. And I think it sums it up pretty well. But I also think you're right, because there's very few investments that you would be comfortable putting 40% of your net worth into and then not looking at it once for 5 years, right? But if it's only 10%, maybe you're much more willing to make that gamble, because you still have what's left over. You still have most, if not nearly all of what you've saved. So it's not as risky, right? It makes sense, but you're right. He did it with Coca-Cola. So what were the determining factors that allowed him to put more into Coca-Cola than he would advise anyone put into any one company?
Yeah, all very interesting points. Yeah, JP, to your point, Warren Buffett definitely contradicts what he wrote here about diversification and sizing when it comes to his investment with Coca-Cola. But I think the only takeaway really is that we shouldn't diversify for the sake of diversifying. I think you also mentioned that before. Um, and when there is an opportunity that we really understand that aligns with all the tenets written here, then and only then it is worth to go over that threshold and size more significantly. Even 30, 40%. But all of this is very vague, and I really want us to kind of like read more about case studies after this book as a follow up, because I agree that there's not enough information here, although we have a general like high level idea on what factors we should consider when we determine our sizing and diversification, but still it's not, we don't have the real life tools that we can rely on yet.
Like, do you know how many firms Berkshire Hathaway owns right now? Like, that's public information, right? Like, how many different stocks they own? Like, is it actually 10? Like, I have a feeling that to my basic knowledge, without looking it up, I'm pretty sure it's above 10 by quite a bit. So it's like, well, that's what you write about and that's what you say. Well, can somebody verify that for sure? Like, maybe I can look it up, but
Yeah, I'm hearing.
like,
I'm seeing on Google. It's more than 50.
yeah. So it's like, wait, so how is it different? Like, if your philosophy about investing is X, is it different that you're a corporation versus an individual? Like, why is
Yeah,
it
that would be
that
my
if
guess.
you are preaching the most optimal way of making money, then it shouldn't technically matter whether you're a firm or an individual? So why is it that you have 55 and you're saying that you should have very low diversification? So it's like, which one is it?
My
And
guess would
maybe
be
there is an explanation to it. It's just not explained in this book, nor do I understand his full philosophy.
It's a rule of large numbers problem. He has hundreds of billions of dollars, so there are only so many businesses that are even of that size. Right? He would prefer to buy businesses in full. There's literally only a handful of businesses in the world worth more than Berkshire Hathaway in its entirety. So his last, I guess, big buy was Precision Cast Parts, which was a bad one, which he paid $32 billion in 2016 for. So I mean, that's a big company, especially in 2016 dollars. I'm looking at the top 100 companies by market cap. I mean, you're talking about the 100th largest company in the world is 115 billion. So there's just mathematically, they cannot. There's only so many companies that exist, right? It was also interesting that chapter 11 was titled "The Psychology of Money" and had a few examples that overlapped with stuff that was discussed in The Psychology of Money that we read earlier this year. Those emotional things that I think are easier said and easier stated than done. So the last two chapters of the book kind of speak to that, and kind of while we can try to emulate what the Warren Buffett way, those aspects are also vitally important. And most people goes back to, I think, what Buffett explicitly said: if you can't tolerate a 50% drawdown in an equity, you shouldn't be investing in the first place. But a lot of people, they see a big drawdown and the first thing they're thinking is selling because they want to get out of it. They don't want to take any more pain. And if you've actually on the due diligence and concluded that the value is X and the stock is now trading at an even more massive discount to that X, that you should in fact be buying more. But it's much harder to do that in practice.
Yeah, definitely. I think we can, unfortunately, I think we can all relate to that. Yeah, that's the really hard part. At the end of the day, it really comes down to, being confident in ourselves and having the discipline to remain strong at times of volatility. It's definitely easier said than done. And yeah, as you pointed out, yeah, yeah, carry on. Like it just sounds easy. Carry like sure, I try every day to carry on, but especially for lay investors like all of us, it's so hard. Even with all the, I mean, that's part of the reason why we have these book clubs, right? To to read the words of the world's greatest investors say these things so that we can have more confidence in carrying on, ignoring the volatility. But especially in a market environment like this, um, the psychological factors, the psychology of money is more important than ever. And it's always a humbling reminder that we're all just human, and we're all here to make money. But at the end of the day, our decision making will always be blurred by our human psychology factors, and we should always be mindful of that. And that is the only way to carry on, as Warren Buffett so eloquently put.
Yeah, and confidence is also very dangerous. I think like if you the commonality between all the really famous investors and the books that we've been reading, the commonality is that there's got to be very good balance because even in the behavioral finance section, they're talking about like confidence isn't a bad thing, but overconfidence is, and that leads to overreaction bias and it could lead to very bad things. But if you're also passive, then not confident, then you're also going to cut yourself short. So it's like you can't be more of one than the other is like how I see it. And the message that I'm getting from all of these books is like you can't lean on one side too much, or like you just got to find the middle point. And that's a very hard thing because you try to over adjust and that over adjust becomes overreaction and that might not be good. So I think yeah, so that's why to Han's point, these book clubs are very helpful in the sense that we're continuously talking about it and we know these things, except when you talk about it, it's like a reminder. You're like, oh yeah, maybe I'm acting this way. You kind of question yourself and you kind of put yourself in check. So I really love having these kind of discussions.
Stuff. Well, as we get to the top of the hour, I would welcome any other thoughts from anyone that we didn't get to touch on, or if they want to maybe really drive home last point, and we can wrap as we put the bow on. I guess our second to last one of the year, because I guess we're gonna have two more. One come the end of October, and then we're going to kind of do one for November, December. So two more as we round out the year, and then we think about how we want to continue with these moving forward. But I mean, I agree with the notion that especially now that we've read several of these really famed investing and finance related kind of tomes, that there's only so many ways you can rehash a point, and there's not going to be some glorious insight that has been missed by everyone else for decades. It's usually just putting it maybe into plain terms that makes sense to you and speaks to you in a way that perhaps others haven't, because all this stuff is pretty straightforward. You should figure out what the business is worth, buy it when it's at a significant discount, and otherwise like an owner and think and not be don't fall victim to Mr. Market's desires of parting you with your money and making you become a deranged trader.
Yeah, 3Pete sent in a link to the Berkshire Hathaway top 13F holdings, and you see percentage of portfolio is 51% for Apple, which is quite a bit higher than that 10% talked about in the books. And then goes down and talks about everything below that is under 10%. So it's almost like Apple's like a substitute. It's just everything else is under 10. But it's interesting. Check out that link if you want to see some more.
All right. Well, looks like we're on time.
That's quite impressive. That the Apple holding. Those are just to kind of give my wrapping thoughts. It's always a very delicate balancing act. We never know whether we are too confident or too sheepish when we make our investments. And I really like we've all heard John mentioned the analogy of that investing is like 4D chess, that we're always thinking about making the next move, but the playing field itself is constantly changing, and there are new things to learn, new information to process, and we never know whether we are right or wrong until at least 5 years after we make the investments. And there are all these, and the playing field will always keep moving until we get to that point. So it's a humbling reminder that the investing game will never know for sure. But the only thing we can rely on is to keep reading these wise words of the world's greatest investors, and keep reminding ourselves of the discipline to learn, to study, to process all this new information, so that eventually, when we look at companies, we understand more of these new markets, new technologies, new companies, and have more confidence in ourselves and our knowledge to evaluate better.
Couldn't have said it better myself, Hong. I think we can wrap on that pretty much on time. So thank you, everybody, for listening to this edition of our Wook Book Club, our monthly chat on investment literature. We'll be back last Tuesday of October as we wrap up the year. Joe, what is this month's book?
So for this month, we're looking at The Little Book That Builds Wealth by Pat Dorsey.
Another little book. I love it.
A lot of little books. And then we have to decide for December still. We have to I've been informed by Nathaniel Popper he is delaying the release of the book till middle of next year. So his book on GameStop and Wall Street Bets delayed. So we'll have to pick something out for December. Open to any suggestions at all. Feel free to use the forum page on our Discord to send in any.
All right. Very good. Well, I'll stop recording then on our end, and we'll talk soon, everyone.